And joining us now, Daniel Rosen, economist at the Rhodium Group. That's a New York-based financial research firm. And Daniel, it's great to have you back on the program. How are you tonight?
Good to be back.
Glad to see you there. Let me start by reading something that the Speaker of the U.S. House of Representatives, Nancy Pelosi, said just a couple of days ago. She said, "For so many years, we have watched the China-U.S. trade deficit grow and grow and grow. Today, we are finally doing something about it by recognizing that China's manipulation of the currency represents a subsidy for Chinese exports coming to the United States and elsewhere." She was referring to the Currency Reform for Fair Trade Act, which the House of Representatives passed overwhelmingly. Lots of Republican support on that as well. How did it get to the point, Daniel, that people in high places in the U.S. government are alleging that China's currency manipulation could spark a trade war?
This has been a long time coming, of course. China and the United States have had a trade imbalance for decades now. Over the past 7 years, it's gotten much larger. It's the largest imbalance between any two countries in the world. You know, between 2005 and 2008, the Chinese were allowing their currency to move to help address the extraordinary size of their global surplus. Then, in light of the global financial crisis, they took a holiday on that and stopped letting it move. That's pretty understandable, pretty reasonable. But by the beginning of this year, their pattern of surpluses was coming back again. It was clear that the patterns we had seen before were returning. What didn't return was their willingness to allow the currency to play a role in helping to address and moderate those extraordinary surpluses. So I think obviously people focus on the U.S. elections upcoming as one reason why this was brought to a vote at this time. But I think quite apart from the U.S. election cycle, this issue would be the supercritical issue it is today, because 6 months, 9 months now after these unacceptable imbalances started returning to the center of the story, China is maintaining its reluctance to acknowledge that the exchange rate is one part of that story that needs to be dealt with, preferably in a multilateral format. But if it's not going to be dealt with multilaterally, then China's major trading partners are going to ultimately take their own unilateral steps to try to address the situation.
Well, I don't want to overdo the political angle here, but obviously with the midterms just a few weeks away, I don't want to ignore it either, and you just touched on it a bit there. But how much of this U.S. policy do you think is driven by actual distress with what's happening financially, and how much of it is based on the fact that, you know, you've got some pretty competitive midterms coming up?
I obviously, politics is politics, and politics creates an audience for this kind of tough talk. But to be frank, the attempt by the U.S. to work with the Chinese in a more collaborative way, preferably multilaterally, has been going on for years and years and years. And it's not just the United States that has these concerns about how China thinks about its exchange rate. The Chinese attitude is this is a purely sovereign domestic matter for us to decide what our exchange rate is. But of course, every exchange rate has two sides to it, right? There's another currency on the other end of that. So this is part of a continuing process of trying to convince the Chinese side that as a major part of the international economy, they have to work collaboratively with the other large players out there. Otherwise, people are going to fall back on just taking whatever measures, perhaps in some cases protectionist, they have resort to at home. So definitely politics has a part to play in this, but this is part of a much longer chronology and story, which goes back through cycles and cycles and cycles of politics, and is definitely, I think, not just linked to these elections coming up in the U.S. in a few weeks.
Okay, fair enough. But for people who have not followed this as carefully as you have for as long as you have, let's go back to sort of first principles here. Why does a country want to control the value of its currency relative to others to begin with?
Well, let me start by saying that a country has good reasons to want to do that, and there are some good reasons not to do that. If a country is going to try to control the rate, its exchange rate, and it ends up creating all sorts of uncertainty about policymakers intervening and gumming up the normal functioning of markets, then it can be very disruptive. So I think ideally a government would not want to have to intervene. That said, given the nature of global financial markets, you have speculators trying to make a bet on this currency and that currency, there's a natural tendency for there to be volatility in exchange rates. An exchange rate is a price between two currencies, right? and it changes dramatically what the price, the retail price is for goods in the United States coming from China, what that rate might be. So there's a strong motive on the part of governments, especially in a developing country like China, where there's so many other forms of business risk that firms and producers have to confront. Labor costs changing, political unrest in some places, all sorts of business cycles, all sorts of things can mess with companies. The exchange rate volatility is just another concern that, if it's too volatile, will scare away investors. So a country intervenes to try to stabilize the rate to some extent in order to give business people a little bit more certainty, a little more confidence that that source of risk to whether their goods are going to be competitive or not is not going to be, the biggest headache that they have to worry about.
Okay, I appreciate the fact that, sorry, let me just follow up with this. I appreciate the fact that there's some disquiet on the street when countries overdo it with their manipulation or with their intervening. But just explain how that works. How would a country that wanted to move its currency intervene to do just that?
Right, let's talk about the mechanics here for a second. And let's also be precise about terms. There's managing your exchange rate, and then there's manipulating your exchange rate. And there's a big difference here. Many, many dozens of countries, if not 100 around the world, attempt to manage their exchange rate. They might have a currency board whose job it is to buy and sell that currency to maintain a certain peg, a fixed price against another currency, most typically the US dollar. That is not, on the face of it, wrong or illegal or inappropriate, provided that the government is not doing it in such a manner only designed to create a huge export surplus for that country. So you can keep a rate stable, but not be trying to beggar thy neighbor, is the term, grow based on somebody else's consumption rather than worrying about consumption at home. Now, in terms of the mechanics, what is, say, the Chinese actually doing? Well, for the past 3 to 5 years, they've purchased $1 billion of US and other foreign currencies every day in their market in order to create an artificial shortage of those currencies and thereby maintain a high value for the dollar, for the euro, for the yen in some cases too, against the renminbi. What happens is Chinese companies export goods to the US or Europe. They're paid in dollars or euro. As soon as they bring them home and put them in the bank account, they are required to switch those dollars and euro for renminbi, for the Chinese currency. So it gets vacuumed out of their accounts immediately. And by soaking up that $1 billion of currency a day, the Chinese government has the ability to fix the rate, manipulate or manage the rate of the renminbi against these other currencies.
But I guess when you're that big and you're that rich, you can get away with that. Is that right?
Well, when you're that big and that rich, you can do it. But also, it's important that China has a closed capital account. So the renminbi is not shipped offshore for use in transactions around the world. When China pays for goods it imports, it doesn't ship renminbi to those countries. When China buys securities in a foreign country, unlike the US that can purchase things abroad in dollars, the Chinese use their dollars to make their purchases abroad. If there were a big pool of renminbi outside China, then the US could do a countervailing currency intervention and simply buy up as much renminbi as the Chinese were buying dollar and essentially force the exchange rate into more of an equilibrium. But as long as China keeps its capital account closed, we can't do that. There's a cost to China from that. The renminbi is not an international currency. In many ways, their international financial influence is much, much lower than it would be if their currency were tradable, the same way that the dollar, the yen, the ringgit, the euro, all these other currencies are.
Okay, Daniel, you can't see this, but I'm going to share this chart with our viewers here. This is, in effect, a visualization of what you've just been talking about, China's stable currency. We want to show a graph with 3 different currencies here. We've got the Brazilian real, we've got the euro on the bottom, and then the Chinese renminbi in the middle. And we can see essentially that the renminbi has been remarkably stable over the course of the last 6.5 years, whereas the Brazilian currency and the euro both tend to go up and down like an echocardiogram or something. There's lots of ups and downs on that. So you looking at that chart, what would you take out of that that you think is important for us to know?
There's a number of things that on the chart you're looking at that are very important. The first thing I would point out is that those movements of the Brazilian real and the euro against the dollar aren't just about speculators, intervening in markets and screwing around with things. that reflects structural changes in the growth rates in our economies, right? The currency rate between us and the Brazilians, or the U.S. and Canada, or U.S. and Europe, is going to naturally change if the expectation about growth in the U.S. is much higher than Europe. Then people will tend to want to buy U.S. dollar assets and securities and company stocks and things like that, and therefore the value of the dollar will go up some. Much of what we've seen over the past 7 years is a structural change in the expectations about the U.S. We recognize, we accept that the U.S. has a deficit in structural problems here at home that are going to lower our growth for some period of time. And therefore, one should expect the euro and the Brazilian currency, especially Brazil, which has terrific growth prospects right now, to go up somewhat against the dollar as investors prefer to go to those higher growth economies. The fact that the renminbi line on your chart is so flat is indicative of the fact that the Chinese have leaned against the natural tendency of their currency to rise, given the better growth prospects that everybody knows characterize the Chinese economy. So that's what describes the divergence there, that other economies aren't leaning against natural market instincts the way the Chinese are. This raises a concern, not just for the United States, of course, but for all these other economies in the world that have to compete against China just like the U.S. does.
Well, we know the U.S., as all major governments, like to use carrots and sticks to get what they want. They've tried the stick with this new bill coming out of the House of Representatives targeting imports from China. Are there some carrots out there that they have still not used that they could in order to have the Chinese play ball on the currency issue the way they would prefer that they played ball?
You know, I wish the answer were yes. If there were carrots within easy reach, I think they would have been put on the dinner table by now. As I mentioned before, folks have been trying to find a cooperative mode of going forward with the Chinese side for some time. And in fact, many in China, including China's central bank, would have preferred to take a more collaborative, multilateral approach to gradually allowing the renminbi to increase. There are political forces in China that have tamped that down and prevented that solution from being taken. So there's not too much carrot left at this point. I think probably and most frighteningly, the greatest motivating force for the Chinese today is that the very faith in the norms of international cooperation that have prevented these kinds of currency war talks, this kind of rhetoric from becoming part of the discussion, confidence in those norms prevailing is starting to fray very severely around the edges. Nobody's going to lose more from a currency war, a general trade war, than China, given how much China is benefiting from its continued globalization in the world economy. So I think for China, you know, the prize here is to get in the game as quickly as they can and demonstrate a willingness to work multilaterally with pretty much everybody else that wants them to come to the table and do something more than they've been willing to do thus far. That's the payoff for them. Unfortunately, it's preventing a real catastrophe that's going to be their payoff, not getting some inducement to do the right thing.
And in our last 30 seconds here, Daniel, I see Martin Wolf in the Financial Times today has said it's time for a currency war. You agree?
I don't think Martin really wants to see a currency war.
Well, he says he does.
What he's saying is that, you know, unfortunately, sometimes you have to be willing to accept the reality of that kind of a tussle, that kind of a fight, in order to prevent it from happening. As long as we're utterly, you know, averse to even the prospect of it, then I think that is going to create circumstances where the Chinese feel like they can continue to just take a self-interested position because they know we won't let that happen. At some point, it becomes, you know, half a dozen of one, six of the other, whether we take the combative approach or whether we take a more collaborative approach. We've got IMF meetings in Washington this week, and I'm still hopeful that that course of events can be avoided. I think it's in China's interest, and we may be yet surprised by their ability to come at the last minute and show that they can do the right thing, that they're ready to do the right thing.
Daniel, as always, thanks for joining us on the line from New York. Appreciate your time tonight.
My pleasure, Steve.